Microsoft recently reported 2Q25 results and they crushed Wall Street expectations. I spent 20 hours building a financial model on Microsoft, and I have to show you what I discovered. I saw something that blew my mind. Despite all of this, the stock is down over 7%. So is now the time to buy Microsoft? Let's dive in and find out. In this video, I will cover Microsoft's recent results and what it means for their future, what I think about Microsoft stock and its value, what Wall Street's smart money says, and what you should do based on this information. Microsoft is going all in on AI with deep enterprise adoption, record-breaking investments, and a cloud infrastructure designed to scale AI globally. The big question, will Microsoft's AI-first strategy turn into explosive profits, or is the AI hype cycle nearing its peak? Let's break it down. Azure is on fire. Cloud revenue jumped 31% with AI services growing 157%. Azure's OpenAI-powered apps on Azure databases have more than doubled in usage year over year. Microsoft's AI business has hit a $13 billion annual run rate, up 175% year over year. CEO Satya Nadella emphasized that AI demand is accelerating faster than expected. Copilot seat purchases have grown 10x over the past 18 months, and existing customers are expanding their deployments at an aggressive pace. OpenAI has made new multi-billion-dollar Azure commitments. Microsoft's exclusive cloud deal with OpenAI continues driving major AI workloads onto Azure. Microsoft expects AI to reach mainstream affordability much sooner than expected, driving a new wave of adoption. Microsoft doubled its total data center capacity in the past 3 years and added more capacity in 2024 than in any other year in history. AI-related capital expenditures will remain high in 2025, but are expected to moderate in 2026. While the company is spending billions, it will support revenue growth for the next 15 years and beyond. If you're enjoying this, please smash that like button. When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financials. Would you buy a house without knowing the size, location, dimensions, or condition?
Nah, I'm good.
That is exactly what you're doing when you buy a stock without understanding the three financial statements. If you want to value companies like the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases and we win. Microsoft has over $18 billion of cash, and if we combine the cash invested in securities, it is over $75 billion. This gives the company a stockpile of cash to invest in the future, whether it is AI infrastructure or their rapidly growing cloud business, Azure. PP&E increased 42% since 2023, and it's projected to more than double in 5 years by the end of our model. The bulk of the capital expenditures growing the PP&E is due to the previously announced $100 billion Stargate project with OpenAI. This partnership aims to achieve artificial general intelligence by 2028, though the recently announced bid by Elon Musk for OpenAI may throw a wrench into things. I actually covered this in my previous video, which is linked above and appears in the description. While debt increased to $51.6 billion, it was mostly used to help fund the acquisition of Activision Blizzard, and Microsoft is still net cash, meaning cash is greater than debt by almost $24 billion. This acquisition is partly responsible for the more than 45% increase in retained earnings to over $173 billion. We're going to see this later when we cover the cash flow statement. So what's the takeaway? Microsoft has tons of cash, its debt is manageable, and it is substantially growing retained earnings. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenue minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see.
Simple math, Mike.
Last year, Microsoft generated a massive $245 billion in revenue, with 62% coming from server, office, and cloud. Top-line revenue grew 15.7% in 2024, and it's anticipated to continue growing in the low to mid-teens over the next 5 years. Margins expanded across the board, which is a tremendous positive, showing operating efficiency even with high top-line growth. 6 months into fiscal year 2025, Microsoft is continuing to maintain or expand margins, which is a great sign for investors. While net income was flat 2022 to 2023, it grew 22% in 2024. 2024, and it continues its ascent 6 months into fiscal year 2025. The Activision Blizzard acquisition and cloud growth has boosted net income and will continue to do so in our projections. So what's the takeaway? Top-line revenue growth of almost 16% and net income growth of nearly 22% shows that costs are growing slower than revenue. This is a win-win for investors and shows how efficiently Microsoft is operating. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating is the cash company generates internally, investing is the cash demanded for long-term growth, financing is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash, making this positive, not losing cash, making this negative. Operating cash flow is positive and growing rapidly. Operating cash flow increased almost $31 billion, primarily driven by strong net income that Microsoft is generating. Something that I've never seen before is that maturities and sales of investments over the last 5 years was over $278 billion. This is the money Microsoft is making from its invested cash, but that isn't even the craziest part. Share repurchases and dividends over the last 5 years were $214 billion. So Microsoft has netted $64 billion on its invested cash. While we see almost $30 billion of debt issuance, nearly all of it was paid off in 2024. The bulk of this debt was used in the $75.4 billion buyout of Activision Blizzard, which has added to Microsoft's bottom line. So what's the takeaway? Microsoft is using the returns generated from its cash to reward shareholders, and it has money left over to invest in AI infrastructure and continued growth in its cloud business. So what does all this mean for the valuation of Microsoft's stock?
I don't know.
Let's cover that next. On Wall Street, we built a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we can take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to value companies like we do on Wall Street so you can build generational wealth, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and it's in the description. As you can see on the left, we take specific line items we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of $4.06 trillion. If we divide by the current shares out, we get an implied share price of $546. Compared to the current close of $411, that's nearly a 33% discount, which is a screaming buy rating. On Wall Street, we buy companies when there's greater than 20% discount. The reason we do that is so that we have a margin of safety. So what does Wall Street have to say about Microsoft stock?
I'm all ears.
Overall, while some analysts have adjusted their price targets due to concerns over Azure's growth and increased AI-related spending, the consensus remains optimistic about Microsoft's long-term prospects in AI and cloud services.
There are things to be optimistic about.
D.A. Davidson lowered their price target to $425 with a neutral rating. So D.A. Davidson downgraded Microsoft to a neutral rating, expressing concerns over the slowing growth in Azure's non-AI segments. The firm highlights potential risks associated with the company's heavy investments in AI and its impact on near-term profitability. Evercore ISI has a price target of 500. Also, Evercore ISI reiterates an outperform rating, viewing Microsoft's increased capital expenditures in AI as a strategic move to capture future growth opportunities. The firm believes that the current stock pullback presents a buying opportunity for long-term investors. Morgan Stanley lowered their price target from 540 to 530. Morgan Stanley maintains an overweight rating, emphasizing Microsoft's leadership in AI integration across its product suite. The firm believes that the company's AI initiatives will drive long-term growth, justifying the high valuation that they have on the company. This is a screenshot of CapIQ. 49 analysts cover Microsoft on Wall Street, which is a lot. The target price ranges from a low of 420, which is a 2% increase, to a high of 650, which is a 58% increase. All upside, even in the worst case scenario. The median is 500, which is a 22% increase. The overall rating on a scale of 1 to 5 is 1.41, which is a buy rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I am a huge believer in Microsoft, and it is the third largest position in my portfolio at just under a 10% weighting. Microsoft's financials are rock solid, and they're rewarding investors substantially. Despite having $250 billion in revenues, Microsoft is growing in the low to mid-teens. Gross margin is close to 70%. And if that isn't enough, they have over $70 billion in cash, and return on invested capital is 30%, which is double Warren Buffett's 15% benchmark. Also, Microsoft keeps rewarding shareholders with steady dividend hikes and aggressive stock repurchases. Microsoft is dominating AI, with AI services revenue up 157% year over year. Copilot, OpenAI partnership, and Azure AI are just getting started. Despite the heavy investment in AI, they can afford it. And I think that Microsoft will be the big winner in AI innovation.
That's a lot of money.
Copilot Studio is enabling custom AI agents. Companies have built over 400,000 custom AI agents in just the last 3 months. Microsoft is a cloud growth machine. Azure's 31% growth is outpacing AWS and Google Cloud. Enterprise demand remains red hot. AI-driven cloud demand is skyrocketing. Enterprise AI adoption is accelerating as companies scale their AI workloads. Microsoft hit a 52-week high of 468 back in July, and it's down 12% since then. Despite delivering incredible financial results, the stock has traded down as analysts question the company's heavy CapEx spend on AI. My model shows a value of $536, which is a 33% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Microsoft presents a compelling value for a company with a dominant position in the AI, cloud, and operating system space.
They're taking over the world.
Microsoft stock is presenting investors with an incredible buying opportunity in a company with rock-solid financials that will help you sleep easy at night. And I think investors will look back wishing they had bought at these levels. If you like this and want to see another in-depth stock valuation, check out my meta video here, or check out my analysis of Elon Musk's offer for OpenAI right here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.